capital gains tax when selling a business. If you're about to sell your business or a building you've held for 20 years, somebody is going to pitch you a deferred sales trust. I want you to hear this from someone who doesn't sell them. The strategy is real. I'm not here to debunk it. But the main thing they're selling you is already free and almost nobody says it out loud. I'm Cody, a former NYPD lieutenant, now a CPA for over 23 years, and a certified tax coach. My firm works with marketing and advertising agency owners all day long, more than 70 of them every month. Before we get started, if you own an agency or you hope to one day, subscribe to the channel. I post in-depth videos covering taxes, profitability, cash flow, agency finances, and the strategies successful agency owners use to grow while keeping more of their money. Here's the mechanics, and it's simpler than the brochure makes it sound. Instead of selling to your buyer, you first sell your asset to an independent trust. You're not making a gift, it's a real sale at fair market value in exchange for a note, a promise to pay you over time. The trust then sells the asset to your actual buyer for cash. Because you took back a note instead of cash, you didn't realize the whole gain in year one. Under Section 453, you pay tax as payments arrive. That's it. That's the strategy. One quick thing, because this trips people up in real deals. There's another DST, known as a Delaware Statutory Trust. That's a fractional real estate vehicle people use inside of a 1031 exchange. Completely different animal, but same three letters. If someone in your closing says DST, stop and ask which one they mean. Now's the part that should decide this for you. You do not need a trust to defer this tax. If you sell your business and take back a note from your buyer, you already get the installment treatment. Same Section 453, no trustee, no setup fee, no annual fee. Congress wrote that into the statute and it costs you nothing. So what does the trust actually add then? One thing, it takes your buyer out of the equation. When you carry the note yourself, your deferral depends on the buyer staying in business and paying you. If they struggle, your money is at risk. If they refinance and pay you off early, your deferral collapses and the tax comes due all at once. The trust replaces that promise with a managed pool of assets. That's a real benefit. It's also the only one. And now you can price it honestly. And here's what I mean by that. You're not comparing the trust against your entire tax bill. That's the comparison that the brochure wants you to make. You're comparing trustee setup and annual fees against one specific risk, and that's the risk that your buyer doesn't pay. If your buyer is a well-capitalized firm paying cash at closing, that risk may be barely existent. You'd be paying real fees to insure against something that isn't going to happen. Run those two numbers side by side. And here's the piece I've never seen anybody cover, because every article on this is written about rental property. When you sell a business, you're not selling one thing, you're selling a pile of assets, and the purchase price gets allocated across them under Section 1060. Each piece is taxed differently, and only some of them can use the installment method. Watch what happens in a $4 million sale. These numbers are an illustration, not client. Goodwill in the client list is $3 million. Capital gain, that part gets deferred. A non-compete, $400,000, ordinary income. A consulting agreement, $300,000, that's pay for work you haven't done yet, ordinary income. Cash basis receivables, $250,000, ordinary income when you collect it. Equipment and computers, $50,000. Depreciation, recapture, and Section 453I says you get taxed in the year of the sale no matter what. So about $1 million of the $4 million deal is taxed up front, and no trust is going to change that. Which now brings me to the thing I'd actually want you spending your energy on. Negotiating that allocation moves more after-tax money than the trust does. Moving a few $100,000 out of a non-compete and into goodwill is worth real dollars. It costs you nothing but attention, and it happens before anyone mentions a trust. Now the risk. Straight away, the IRS has never issued a ruling approving this structure. No regulations either. It rests on the statute and a line of court cases, which means your deal stands on its own facts. Courts have allowed it where the trustee was generally independent. They denied it in a case called Luscarton, where the seller still controlled the money, that seller got taxed on the entire gain immediately. Currently, the IRS is looking at promoters. In 2024, it went to federal court to force one deferred sales trust firm to hand over its client list. So the trustee, it cannot be your brother-in-law. It cannot be somebody you can fire when you want your money early. The second you can reach the cash, the deferral is gone. And if you need a lump sum at closing, this probably isn't your vehicle. Before you sign anything, have somebody read your allocation. That's the highest value hour in your whole sale. How is the purchase price allocated? Book a free tax analysis at CraigCodyandCompany.com. Sometimes the honest answer is that a plain note does the same job for nothing. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.